Employee share schemes are like the cherry on top of your job package. They're designed to incentivize you to remain with the company you work for, but they can also be a really good way to build your personal wealth. But they're a little bit like stocks. No two are the same. They vary a lot. Each company has its own set of incentives, rules, tax implications, and it can be a little bit of a minefield to get your head around. So while I can't go over every single scheme out there, I can give you some little nuggets of advice that I've come over the years of helping clients manage their schemes. Now, before diving into some of the key considerations of employee share schemes, let's first of all just take a high-level look at some of the more common schemes that are out there. The match shares. This is where the company provides additional shares for every share you purchase, often with a vesting period. So for example, buy one share and the company gives you one, subject to remaining employed for a certain period. The shares purchased at a discount. You buy shares at a price below their market value. Acquiring the shares for less than what they're worth gives you the potential boost to your wealth when the shares vest. Share options. So instead of getting shares, you receive the right to buy shares at a specific price in the future, often below the market value. These options may be subject to vesting conditions or performance targets before they can be exercised. And performance-based shares. These shares are provided as part of your package or as a bonus, but they only vest if specific targets such as revenue goals or individual performance metrics are met. These are just some of the employee share schemes that I see most often, but there are definitely others out there, and each have their own tax implications, incentives, risks, and benefits. Next up, I think it's important we talk about vesting periods, because I've already used that term a little bit, so let's dive a little bit deeper into it. Okay, so you've been offered shares in your company as part of an employee share scheme. That's awesome. But here's the catch. They're not actually yours straight away. They're often subject to what's called a vesting period. Generally speaking, if you purchase shares in the company that you work for, then those shares you purchase, they're yours straight away because you've paid for them. But if the company give you any shares, whether that's through match shares, bonus shares, or part of your remuneration, then those shares are generally subject to a vesting period. And here's how it works. The grant date, this is when the company says, hey, we're giving you these shares, but it's more of a promise than a gift right now. The vesting period, this is like the company saying, stick with us for a bit and these shares are yours. It's almost like they keep this carrot dangled on the end of a stick for a period of time. It's usually between 1 and 3 years. Some schemes also include additional requirements like hitting performance milestones, which are more common in executive roles. And 3, the vesting date. Once this date rolls around, the shares officially become yours. You can keep them, sell them, or just admire them because you are now part owner of the company that you work for. Quick little tip, if you receive match shares, then the shares that you purchase yourself, they're yours straight away and you can sell them. However, if you do sell them through the vesting period, then generally you're going to lose those match shares. You have to hold on to the ones you purchase for a period of time to get the match shares. Now let's talk about tax, and pay attention to this bit because this is where a lot of people get confused and go wrong when it comes to employee share schemes. If your shares are subject to a vesting period, then when they vest on that vesting date, then some or all of the value of those shares are going to be assessable income. It's going to depend on the individual employee share scheme you're in, but generally speaking, if you go through a vesting date, you get shares at the end of that vesting date, that's going to be assessable income. There are 3 common tax scenarios for employee share schemes. Number 1, shares purchased at a discount. If you purchase shares at a discount, the ATO will tax the difference between the market value of the shares on the vesting date and the amount you paid for them. The discount is considered assessable income. For example, if the market value of the shares on vesting is $10,000 and you paid $6,000 for them, $4,000 is added to your taxable income. This is normally where share rights are issued. Number 2, company match shares. If the shares are matched by your employer, i.e. you didn't pay for them, the entire market value of the match shares on the vesting date is taxable as income. For example, if the market value of the shares is $10,000 and they were fully matched by your company, the full $10,000 is added to your taxable income. Importantly, the shares you purchase to qualify for the match are not taxable. Only the employer match portion are. And 3, gifted shares. If shares are given to you as part of your employment agreement or bonus, then 100% of the shares value at the vesting date is considered taxable income. For example, if you receive $5,000 worth of shares as a bonus, the full $5,000 is added to your taxable income at vesting. The biggest trap is that unlike salaried income, no tax is accounted for through the PAYG system. So when vested shares come up and you lodge your tax return and it's all included in your tax return, then you can get hit with this big unexpected tax bill. So we've talked about the taxable income as a result of just simply receiving shares. But what about capital gains tax? When you sell your shares, capital gains tax is going to apply on any gain made above the cost base. And so for discounted shares, the cost base is going to be what you paid for them plus any taxable discount. And for bonus or match shares, the cost base is going to be the value of the shares at the vesting date. As a little tip for match or gifted shares, if you sell those shares within 30 days of the vesting date, then the cost base shifts to the date of the sale. So in other words, you don't have to worry about capital gains tax if you sell it within 30 days of that vesting window. Employee share schemes can be a fantastic way to help build your personal wealth. However, the thing that we are most cautious about is that we don't want to tie up a large portion of your asset base to the same company that also pays your income. This is just too risky. Here at Guided Investor, we typically recommend 1, participating in the employee share scheme when you think that the company is solid and the incentives are good. 2, plan for the tax liability and consider strategies that you can implement in order to help offset some of the tax. And 3, when you hit that vesting date, subject to tax implications, consider selling it down and diversifying away from that company. By taking this approach, you can maximize the benefits of your employee share scheme while minimizing the risk and obviously sorting out those nasty tax implications. But that's it for me today, guys. Thanks a lot for watching. If you found this video useful, then please give it a thumbs up and I will see you guys in the next one.